a Wikividi documentaries production. Don't forget to like and subscribe. Enjoy. Gross domestic product. Gross domestic product is a monetary measure of the market value of all final goods and services produced in a period of time. Nominal GDP estimates are commonly used to determine the economic performance of a whole country or region, and to make international comparisons. Nominal GDP per capita does not, however, reflect differences in the cost of living and the inflation rates of the countries. Therefore, using a basis of GDP per capita at purchasing power parity is arguably more useful when comparing differences in living standards between different nations. Definition: the OECD defines GDP as an aggregate measure of production equal to the sum of the gross values added of all resident and institutional units engaged in production. An IMF publication states that GDP measures the monetary value of final goods and services that are bought by the final user produced in a country in a given period of time. Total GDP can also be broken down into the contribution of each industry or sector of the economy. The ratio of GDP to the total population of the region is the per capita GDP, and the same is called mean standard of living. GDP is considered the world's most powerful statistical indicator of national development and progress. History: William Petty came up with a basic concept of GDP to defend landlords against unfair taxation during warfare between the Dutch and the English between 1652 and 1674. Charles Davenant developed the method further in 1695. The modern concept of GDP was first developed by Simon Kuznets for a U.S. Congress report in 1934. In this report, Kuznets warned against its use as a measure of welfare. After the Bretton Woods Conference in 1944, GDP became the main tool for measuring a country's economy. At that time, gross national product was the preferred estimate, which differed from GDP in that it measured production by a country's citizens at home and abroad rather than its resident institutional units. The switch from GNP to GDP in the US was in 1991, trailing behind most other nations. Crucial to the development of GDP was its role in the wartime effort. A crucial role was played here by the U.S. Department of Commerce under Milton Gilbert, where ideas from Kuznets were embedded into governmental institutions. The history of the concept of GDP should be distinguished from the history of changes in ways of estimating it. The value added by firms is relatively easy to calculate from their accounts, but the value added by the public sector, by financial industries, and by intangible asset creation is more complex. These activities are increasingly important in developed economies, and the international conventions governing their estimation and their inclusion or exclusion in GDP regularly change in an attempt to keep up with industrial advances. In the words of one academic economist, the actual number for GDP is therefore the product of a vast patchwork of statistics and a complicated set of processes carried out on the raw data to fit them to the conceptual framework. Determining gross domestic product (GDP). GDP can be determined in three ways, all of which should, in principle, give the same result. They are the production approach, the income approach, or the speculated expenditure approach. The most direct of the three is the production approach, which sums the outputs of every class of enterprise to arrive at the total. The expenditure approach works on the principle that all of the product must be bought by somebody. Therefore, the value of the total product must be equal to people's total expenditures in buying things. The income approach works on the principle that the incomes of the productive factors must be equal to the value of their product, and determines GDP by finding the sum of all producers' incomes. Production approach. This approach mirrors the OECD definition given above. Gross value added, gross value of output, value of intermediate consumption, value of output, value of the total sales of goods and services plus value of changes in the inventory. The sum of the gross value added in the various economic activities is known as GDP at factor cost. GDP at factor cost plus indirect taxes less subsidies on products, GDP at producer price. For measuring output of domestic product, economic activities are classified into various sectors. After classifying economic activities, The output of each sector is calculated by any of the following two methods. The gross value of all sectors is then added to get the gross value added at factor cost. Subtracting each sector's intermediate consumption from gross output gives the GVA at factor cost. Adding indirect tax minus subsidies in GVA at factor cost gives the GVA at producer prices. Income approach. The second way of estimating GDP is to use the sum of primary incomes distributed by resident producer units. If GDP is calculated this way, it is sometimes called gross domestic income, or GDP. GDI should provide the same amount as the expenditure method described later. This method measures GDP by adding incomes that firms pay households. For factors of production, they hire wages for labor, interest for capital, rent for land, and profits for entrepreneurship. The U.S. National Income and Expenditure Accounts divide incomes into 5 categories. These 5 income components sum to net domestic income at factor cost. 2 adjustments must be made to get GDP. Total income can be subdivided according to various schemes, leading to various formulae for GDP measured by the income approach. A common one is GDP compensation of employees plus gross operating surplus plus gross mixed income plus taxes less subsidies on production and imports. GDP CO plus GOES plus GMI plus TP and MSP and M. The sum of CO, GOES and GMI is called total factor income. It is the income of all of the factors of production in society. It measures the value of GDP at factor prices. The difference between basic prices and final prices is the total taxes and subsidies that the government has levied or paid on that production. So adding taxes less subsidies on production and imports converts GDP at factor cost to GDP. Total factor income is also sometimes expressed as total factor income employee compensation plus corporate profits plus proprietors' income plus rental income plus net interest. Expenditure approach. The third way to estimate GDP is to calculate the sum of the final uses of goods and services measured in purchasers' prices. Market goods which are produced are purchased by someone. In the case where a good is produced and unsold, the standard accounting convention is that the producer has bought the good from themselves. Therefore, measuring the total expenditure used to buy things is a way of measuring production. This is known as the expenditure method of calculating GDP. Components of GDP by expenditure. GDP is the sum of consumption, investment, government spending and net exports. Uncertainty C plus I plus G plus. Here is a description of each GDP component. Note that C, G, and I are expenditures on final goods and services. Expenditures on intermediate goods and services do not count. According to the U.S. Bureau of Economic Analysis, which is responsible for calculating the national accounts in the United States, in general, the source data for the expenditures components are considered more reliable than those for the income components. See income method below. GDP versus GNI. GDP can be contrasted with gross national product or, as it is now known, gross national income. The difference is that GDP defines its scope according to location, while GNI defines its scope according to ownership. In a global context, world GDP and world GNI are, therefore, equivalent terms. GDP is product produced within a country's borders. GNI is product produced by enterprises owned by a country's citizens. The two would be the same if all of the productive enterprises in a country were owned by its own citizens, and those citizens did not own productive enterprises in any other countries. In practice, however, foreign ownership makes GDP and GNI non-identical. Production within a country's borders, but by an enterprise owned by somebody outside the country, counts as part of its GDP, but not its GNI. On the other hand, production by an enterprise located outside the country, but owned by one of its citizens, counts as part of its GNI, but not its GDP. For example, the GNI of the USA is the value of output produced by American-owned firms, regardless of where the firms are located. Similarly, if a country becomes increasingly in debt and spends large amounts of income servicing this debt, this will be reflected in a decreased GNI, but not a decreased GDP. Similarly, if a country sells off its resources to entities outside their country, this will also be reflected over time in decreased GNI, but not decreased GDP. This would make the use of GDP more attractive for politicians in countries with increasing national debt and decreasing assets. Gross national income equals GDP plus income receipts from the rest of the world minus income payments to the rest of the world. In 1991, the United States switched from using GNP to using GDP as its primary measure of production. The relationship between United States GDP and GNP is shown in Table 1.7.5 of the National Income and Product Accounts. International Standards. The international standard for measuring GDP is contained in the Book System of National Accounts, which was prepared by representatives of the International Monetary Fund, European Union, Organization for Economic Company Operation and Development, United Nations, and World Bank. The publication is normally referred to as SNA 93 to distinguish it from the previous edition published in 1968. SNA 93 provides a set of rules and procedures for the measurement of national accounts. The standards are designed to be flexible, to allow for differences in local statistical needs and conditions. National measurement. Within each country, GDP is normally measured by a national government statistical agency, as private sector organizations normally do not have access to the information required. Nominal GDP and adjustments to GDP. The raw GDP figure as given by the equations above is called the nominal, historical, or current GDP. When one compares GDP figures from one year to another, it is desirable to compensate for changes in the value of money, i.e. for the effects of inflation or deflation. To make it more meaningful for year-to-year comparisons, it may be multiplied by the ratio between the value of money in the year the GDP was measured and the value of money in a base year. For example, suppose a country's GDP in 1990 was $100 million and its GDP in 2000 was $300 million. Suppose also that inflation had halved the value of its currency over that period. To meaningfully compare its GDP in 2000 to its GDP in 1990, we could multiply the GDP in 2000 by 1/2, to make it relative to 1990 as a base year. The result would be that the GDP in 2000 equals $300 million times 1/2, $150 million. In 1990 monetary terms, we would see that the country's GDP had realistically increased 50% over that period, not 200%, as it might appear from the raw GDP data. The GDP adjusted for changes in money value in this way is called the real, or constant, GDP. The factor used to convert GDP from current to constant values in this way is called the GDP deflator. Unlike Consumer Price Index, which measures inflation or deflation in the price of household consumer goods, the GDP deflator measures changes in the prices of all domestically produced goods and services in an economy, including investment goods and government services, as well as household consumption goods. Constant GDP figures allow us to calculate a GDP growth rate, which indicates how much a country's production has increased compared to the previous year. Real GDP growth rate for year N minus. Another thing that it may be desirable to account for is population growth. If a country's GDP doubled over a certain period, but its population tripled, the increase in GDP may not mean that the standard of living increased. For the country's residents, the average person in the country is producing less than they were before. Per capita GDP is a measure to account for population growth. Brought to you by Wikividi Documentaries. Would you like to know more?